The best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements for today. Well, Singapore shares inched higher to track broader gains in Asia. So if we look at the Straits Times Index, it went up by 0.18%. to 3,910 points at about 2:15 p.m. Singapore time. And that is with a value turnover of some 703 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI ended further in the green, up 0.35% at 3,917 points. In terms of value turnover, we are looking at 1.24 billion Sing dollars. Gainers outnumbered losers, 331 versus 177. Top advances for today, we've got for you Plato Capital, GMHUSD and City Developments Limited. And top decliners, we've got for you Jardine Cycle and Carriage, Hotel Royal and Tanjong International Hong Kong dollars. Well, in terms of companies to watch, we've got Thai Beverage because the beer maker yesterday announced this $2 billion multicurrency debt issuance program. Now, the group said net proceeds from the program will be used for general corporate purposes of the company. Now, also from a softer than expected U.S. private sector jobs report and what that means for global markets, to remarks made and the Fed's closely watched Beige Book study, we've got more international developments in focus. And also on deck, how Citigroup said it will cut the number of employees at two of its tech centers in China by about 3,500. Lots going on in global markets, and joining me on the line on a Thursday is David Chow, Director at Azure Capital. David, how are you?
Hey, hi, Nidian. I'm doing good. How about yourself?
Good. And David, I'm hearing some feedback on my end here, but let's start with the U.S. this time around. If we look at a report by payroll firm ADP that showed private sector jobs rose by 37,000 last month, that is a sharp slowdown from April's 60,000, less than a third of what was forecast in a Bloomberg survey. Now, what does this say about the health of the U.S. economy if we read this in totality with the Fed's Beige Book study out overnight?
Well, I think with this job data, which clearly show a decline, we also have the headline ISM services gauge, which decline as well. So with these two data, alone, it could signal that the economy could be weakening. Overnight, even as the U.S. key stock indexes were steady, no huge decline. The in the bonds market, we were seeing 2 to 10 year yields reach the lowest level since early May. So would this actually make the Fed sit up? While the if you look at the ISM services gauge and its new orders component, while this alone indicated contraction, I think the employment measure of this component unexpectedly actually went to expansion mode for the first time in 3 months. So, and also a gauge of prices, paid by businesses in the sector also rose more than anticipated to the highest level since November, I think end of November 2022. And also, I think what I'm seeing is also a separate U.S. government gauge of hiring strength, which I think released on Tuesday, showed that job openings also rose in April in a fairly broad advance. So I guess with this, the litmus test should fall on this Friday's the non-farm payroll data. So for this, I would expect for Friday's non-farm payroll, I think the market is expecting employment to come in at around 130,000 workers. We are expecting about 120,000 workers, and if an unexpected decline happens on Friday, I think this will what would really make the Fed sit up.
Yeah, so all in, David, how did global markets, particularly markets right here in Asia, react to the news? I believe if we look at Asian markets, shares mostly rose. Of course, you mentioned that the litmus test will be tomorrow for the non-farm payrolls report. But so far, I believe Asian shares mostly rose on the back of hopes that the Fed would cut rates soon. So any thoughts on that?
Yes, the entire market is actually basing its optimism, at least if I look at how they behave today as a whole. the market is, the market, as well, is inching towards the scenario of an upcoming rate cut, but I think it's not so immediate because when I look at traders of swap contract that actually predict Fed rate changes, they are actually still predicting 2 cuts as of end October, or rather in October and December, and the third cut, which is supposed to happen in September, has increased by 90%. There's a chances of 90% cut. So actually ahead of last night's data, traders were actually ramping up bets against Fed cuts this year. So, with this ADP data, I think it drew a swift response from Trump, which I think he did in his social media post that the US Fed needs to cut interest rate, a demand she has been making repeatedly. But then again, unless the economic data worsens significantly, I don't think the Fed will bring the cuts forward. So we are looking at still an earliest September cut.
Okay. Now, zooming in on some of the companies to watch right here in Singapore today, we've got Thai Beverage because it announced this $2 billion multi-currency debt issuance program. Now, basically, it said net proceeds from the program will be used for general corporate purposes of the company. So how significant is the development for Thai Beverage where share price movements are concerned? And if I may add on, how did STI fare in general today?
Right. So I think on Thai Beverage first, if I look at the share price now, I think it's flattish at 46 cents. I think so. I don't think this announcement has any meaningful impact. I think the market is still very much affected by Thai Bev results, which released early last month and showed that revenue and net profit was both down. Revenue decline, I think, was led by the beer business due to lower production, and sales volume in Vietnam, I think, also declined by about 17 to 18%. So I think if I remember the other segments like while the spirits business grew slightly by about 2.1, and we also see a increase in sales volume for domestic and overseas consumption. This non-alcoholic beverages was down, and food revenue was also down slightly as well. So overall, not very exciting. So I think as a result of that, the Street along with us, actually we cut our earnings growth slightly for Thai Bev for the next 1 to 3 years. And I guess the market, if you are a watcher of Thai Bev, or if you are an existing investor of Thai Bev, you are really looking forward to see whether the previously announced potential corporate actions that will be its potential IPO of its beer business is going to materialize later in the year or not. And also on the second aspect, I think the market is also expecting a higher dividend payout, from the present 50% to 70%. So these two are key catalysts for the stock. Other than that, I guess Thai Bev will just be churning along.
Okay. Generally, would you say that the STI is fairly positive for today?
I would say it's in line with the market. I think you were saying earlier it rose 0.2%. Well, it's 3,911 points now, and just, I think, 2.2% short of the all-important 4,000 mark.
Okay.
And I think, in our opinion, the market will have a chance to test this in the coming months.
Okay. Now, if you're just tuning in, we're in conversation with David Chow, Director at Azure Capital. Well, David, another company to watch for today is Far East Orchard. Now, pardon me, it's a bit lengthy over here because a JV agreement between Far East Orchard's subsidiary, Far East Hospitality Management Asia, and Real Hospitality Group Asia in relation to a hospitality management business in China that has been terminated. So, as far as I understand, I think the JV partners intended to incorporate a JV company in Hong Kong as well as an operating company in China for the business. But Far East Orchard said that they were basically unable to find suitable opportunities amid Chinese tourism industry's post-pandemic recovery. Does that signal any wider concerns about the Chinese hospitality market then?
I think we look at the headline fundamentals, news coming out from the relevant industries. So I think while China's outbound travel has yet to fully recover to pre-pandemic levels, domestic tourism has near or exceeded those readings, pre-pandemic, and arguing favorably for most sub-segments of China's tourism industry. And if I look at some numbers, I remember the Chinese domestic revenue, tourism revenue has reached like 5.75 trillion yuan just last year, and surpassing that of 5.7 trillion yuan in 2019. So if you go into the details, if you look at RevPAR of the hotels segment, I think it's still set to remain weak due to a slow recovery in business travel and cool downs in leisure trips. And I think Chinese hospitality companies also saw a downward revision in consensus earnings last year, which followed a slight decline in domestic leisure travel. But if you look at numbers from this year, I believe a pickup in outbound tourism has continued, has started to revive, for the first few months of this year, with more flights at affordable prices and easing travel, visa policies for Chinese travelers. So I guess back to the listed, hotel operators in China, I think in our forecast, like 1.5 months ago, we still, see a profit growth in 2025 through network expansion. And because of this network expansion, these hotel players typically, trade higher PE at 20 to 40 times and high single digit, EV to EBITDA. And without knowing exactly what the Far East people are looking out for, it's hard to pinpoint exactly. So, all I can do here is to highlight some of the fundamentals of the industry.
I see. Well, David, I don't want to stay in Singapore and have a look at Singapore's retail sales numbers. Retail sales basically inched up 0.3% year-on-year in April, easing from the previous month on the back of slower sales at department stores. How far is the number in line with your expectations, and what does it suggest about the outlook of SGX-listed consumption-driven firms?
We think for this round, we don't have an explicit forecast on Singapore retail sales. So perhaps I will have to discuss this in the context of the actual figure versus that of consensus.
Okay.
And if I remember looking at the consensus number this morning, I think it's actually was looking out for an increase of 1.7% following a prior increase of 1.1%. So, if you look at 1.7%, versus 0.3%, this actual data actually fell short of expectations. But if we drill now to the components, we could see that if we strip out the vehicles portion, the remaining numbers actually was up 0.8% year on year. So with this in mind, it's quite resilient in my opinion, and this is also an improvement from first Q, where retail sales growth was flat, and April retail sales gains this round I think was led by computer, telecommunication equipment, as well as the watches and jewelry. So projecting to retail sales data in this month, we could see in May. We could see a potential lift again because of the four concerts held by Lady Gaga. So if you talk about the consumption listed place here, I mean we do have Sheng, which is supermarket consumer staples, and I guess something much more noteworthy will be the retail focus Singapore REITs, because in our research we find that they have approximate 61% exposure to SG retail. So we see potential in lifting, second Q revenue for, more landlords like your CapitaLand Integrated, Fraser, Centrepoint, Suntec REIT, and, Mapletree, Pan Asia on better turnover rents.
Okay, and finally, David, before we let you go, Citigroup said today that it will reduce number of employees at two of its tech centers in China by about 3,500. Of course, as part of efforts to simplify and shrink its global tech operations to improve risk and, of course, data management. What do you make of the move, and really how significant is this for Citigroup?
I think, if I remember, in 2022, Citibank already announced that it was shut its consumer banking business in China as part of a broader retreat across 14 markets. So with this in mind, it's still a continual scaling back of its operations in China. Having divested its onshore consumer wealth portfolio to HSBC in June and exited retail banking in other countries. And despite the job cuts, I think Citibank also has emphasized that its commitment to corporate and institutional clients in China will go on. So this suggests to us a pivot towards more higher value, cross-border banking services rather than your broad consumer operations. And we also cannot discount the fact that this could be also due to rising geopolitical uncertainties and increasing competition from domestic Chinese fintech giants, which are really pushing Western banks like Citigroup to reevaluate their presence in China. And this move also reflects broader trends among global banks, with firms like HSBC and Mercedes-Benz also announcing job cuts in China amid a challenging economic outlook and trade tensions. So for now, we see this as a calculated step, but its long-term impact on Citigroup's global competitiveness and regional presence remains to be seen.
I see, lots to watch indeed, and thanks so much for the insights, David. As always, that was David Chow, Director at Azure Capital. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.